in, because I think you were turning it over to me, but good morning, everybody. It's Mark Miller, and it's good to be with everyone today. And sorry it's been so long since we've all seen each other. But also introduce my partner, Brad Rustin, and two of us are going to just take a little bit of time today to go through what we're seeing on some of the various litigation, unfortunately, that's unfolding, targeting lenders who participated in the Paycheck Protection Program, and just sort of work through a little bit of a timeline, a little bit of what these cases are looking at, what we're seeing, and then shifting to government enforcement that might come down the road, as well as other liability issues and what you can try to do now in present and perhaps even retroactively a little bit to best protect yourself. So with that, Brad and I will give you a little tour, and we'll go ahead and get started. Brad, if you want to hit the next slide. So this just sort of shows a quick timeline of really just a month. And the PPP program was unveiled by Treasury and SBA on the 25th, and I believe the CARES Act of March, and I believe the CARES Act was actually signed on the 27th of March, which was a Friday. And by April 3rd, loans were, that following, I guess, a week later, loans were starting to become available, very, very rushed, obviously. So you have April 3rd, the first loans are available for applicants to apply, and on April 3rd, the first lawsuit was filed. It was against Bank of America, charging that the Bank of America failed to offer PPP loans to new customers. In fact, I think B of A and many other banks on the initial outroll in the first couple of days were very clear they were limiting to their own customers. So April 3rd, first applications are taken, first lawsuit filed. April 11, another lawsuit was filed against Wells down in Texas. Again, questioning eligibility, followed by another case on April 13 in Maryland. They dismissed that case, saying that there was no that this is the case against Bank of America because the CARES Act did not provide a private right of action. So April 20, another case gets filed in California. April 27, another lawsuit against Bank of America. And then also on April 27 in California, a new type of lawsuits filed, this time not against the lender from classes of borrowers, but the first of the, quote, agent fee lawsuits. And, we talked about this a lot back in April, where we had, effectively CPA firms or just other advisors talking to customers of the bank, helping them fill out the application, which was not a very complicated task, especially for, someone's accountant who would have all the information. Of course, not charging any professional fee to the borrower, not charging their time, but then seeking to get the, quote, agent fee from the bank out of the fees that the bank would be due from SBA. Brad, go ahead and hit the next slide. And this next slide kind of gives a lot more detail on these lawsuits, but it's effectively, these third parties that helped a borrower going to the lender to say, hey, we were an agent of XYZ company that you made a PPP loan to. We're their agent, so you have to pay an agent fee. And a lot of the banks very, very quickly just said no. And this, I think, became another problem where we were shoehorning the PPP program into the existing SBA regulations. So SBA 7A regulation defines an agent as someone who prepares or submits on behalf of an applicant application for a loan of any kind from the SBA, someone who prepares or processes on behalf of a lender or participant in an SBA program an application for financial assistance, participating or communicating with officers of the SBA on an applicant's or lender's behalf, acting as a service provider for the lender, or any other activity the SBA reasonably determines makes one an agent. So again, you would have folks that were just talking to the borrowers saying, hey, we're the borrower's agent now and looking for a fee. Again, there was no guidelines under the PPP program as to what an agent was, what a lender would have to do to agree to pay a fee. Just the definitions under SBA 7A as to what forms are filed to be an agent fee, et cetera. So what you had is a lot of lenders, they accepted the application, they processed it, got it on E-Tran, loan gets funded, and then out of nowhere, you have these, quote, agents showing up after the fact demanding payment. And even the AICPA, the accounting, trade organization, basically said these claims for agent fees, it was their understanding that the member firms weren't going to charge for these services and helping clients with the PPP application because, as I said, the application was fairly straightforward, can easily be completed by a small business. The average payroll cost is really easy to derive from the third-party payroll provider, and that the PPPs ask for a self-certification, not any type of CPA, opinion or certification or anything else. So, Brad, I'll let you speak because my mouth got dry, so it's your turn.
One interesting thing to note when we talk about these agent fee provisions is we've seen a lot of the banks with which we work having some issues really comprehending how the agent fee structure was developed. And just remember, it back ends onto the 7A program. And what we mean by that is when you think about these PPP agent fees, understand that the baseline of PPP is it is a 7A lending program, and there is a whole set of standard operating procedures, regulations that apply to agents under the 7A program. And candidly, I think a lot of people who got into the PPP, both on the lender and the on the supposed agents side, don't really fully appreciate what these definitions do. And a lot of these were updated in 2018 to reflect a series of changes the SBA ran through. And so really, as you think about your PPP program from a lender standpoint, understand that you need to be both looking at where you acted potentially as a lender service provider by referring loans to others. Understand who may have been your lender service provider, meaning people who were providing services in lieu of the services provided by the bank, and where that line is, and we'll talk about between a technology service provider and a lender service provider that requires disclosure to the SBA. And then certainly in light of all these lawsuits that are coming through, make sure you've really got a good grasp of this concept of a borrower's agent, because the PPP program is somewhat unique in that, unlike the normal 7A program where the borrower submits all of the information for its agents and those agents are paid out of closing, PPP tweaks that slightly, and there's still this concept of a borrower agent, but it's clear that the fees, if they are to be paid, meaning they're otherwise payable and all the regs were complied with, then it would be payable out of the lender's portion of the fee. And so, this obviously then is the start of where the litigation is occurring, is that these supposed agents are coming in oftentimes months or, sometimes weeks after the closing, sending an invoice into a bank saying, please pay me now. And none of the requirements under the 7A program, these agent fee provisions, were addressed. And so what we've seen is there's a fairly common setup that occurs, which means your bank rolls out the PPP program, you take the applications in, loan issuance, meaning you actually close the loan, and in most of these cases, these supposed lender or borrower agents did not submit a Form 159. They didn't request a contract with the bank to be paid. They didn't take any steps to notify the bank before the closing of the PPP loan that they were going to be seeking borrower agent fees under the PPP. And most importantly, there is not what's called a Form 159, which is this three-party agreement, a disclosure that goes to the borrower, the lender signs it, and the agent has to sign it. And the 7A program has a Form 159. It discloses to the borrower they don't have to use that agent, but it also makes the agent give a series of certifications, in particular that the fees are reasonable and that they were non-contingent. And so if you're getting these invoice demands where people are coming in and saying, hey, here are, we're requesting 1% of the fee, which, we'll talk about in a moment, was the maximum that could be claimed for certain PPP loans. And you're getting a small CPA firm or someone else saying, please remit 1% of the amount of the loan to me. you've really got some questions regarding the reasonableness. Now, interestingly, one of the challenges is under the 7A program, it's up to you as the lender to diligence those agents, meaning it was up to the lender to make sure that the agent was licensed, could do what they were providing, made the correct certifications. And so for that matter, or for that reason, a lot of banks and lenders just chose not to deal with agents because it'd be a significant delay in the process when we're trying to get these funds out to borrowers. Certainly something to think about as you articulate your position on these PPP agent fee cases is, there is a significant process involved in the 7A program requiring lenders to conduct due diligence on those agents. Not only do you have to have the necessary forms, but you've got to have those certifications, and you've got to, in some circumstances, get copies of the agreements between the agent and the borrower so that those can be included as well. In the last few weeks, the recruiting has gotten extreme, meaning there are plenty of websites. If you just Google PPP agent fees, you'll find a number of websites actively recruiting CPAs or others trying to get them to serve as plaintiffs in lawsuits against banks and other lenders in these agent fee cases. And then usually you'll see the setup email. We've seen some where they just simply send in an invoice. Some will call. Some will try to hide it in a larger email where they'll send it to a frontline lender and say, hey, I have the following questions about an application we help process for one of our customers. And somewhere in there will be, we need to know how we submit our agent fee claims. And oftentimes we're seeing frontline lenders responding to those in a way that may be inconsistent with your bank's policy, or maybe more importantly, just kind of offhand without fully articulating your bank's policy. Then usually about a week later or so, a lawsuit is filed. As I say, there are lawsuits pending across the country right now, everywhere from Seattle, Washington to the Middle District of Florida, Arizona, a number in California, Georgia. Almost more than 5,000 financial institutions have been named in these lawsuits so far. And so with that type of concern, just understand any sort of discussions about agent fees are potentially a landmine that your bank could land upon. So really be careful and deliberate in your response. Make sure you're clearly articulating your bank's position and responding to these so-called agents, and then making sure you're coordinating that with your legal counsel as you articulate that response. One thing we've done here for your future reference, these are the known plaintiffs in these lawsuits, meaning that these are the people who have already brought lawsuits. We've seen a few of them be very active, such as Alliance CPA Group, Ratliff CPA Firm in the Southeast, Panda Group in California. But certainly, should you receive a communication from any of these individuals, or these firms rather, make sure you're cognizant that this is potentially a setup email, and you may be shortly named in the litigation. And so really be careful anytime you're dealing with anyone on this list, or more generally, specifically, as you get questions about PPP agent fees, because they are very aggressively pursuing them and really trying to set up banks and trying to trap them oftentimes by sending a communication to a frontline lender, to someone who is in a customer service role in your SBA program, trying to get them to commit to something that they will then in turn use against your bank in potential litigation. So Mark, you want to talk a little bit about the numbers we're seeing so far?
Yeah, sure. I think that's a good place to start. I mean, I have my own views about the plaintiffs bar, but the one thing I think we can all agree on is there's got to be some money to go after. And if you start looking at just the numbers involved here, I think looking at both charts, the pie graph kind of shows how these loans broke down. We broke down in three categories because that's where the fee breaks were. Less than $350,000. That was a 1% fee. Well, that was 218 or almost $219 billion worth. So that's $2 billion worth of fees that folks are trying to go after. The 350 to 2 million, that was a 50 basis point fee, but that's still down to $925 million to go after. 2 million and up is a 25 basis point fee, and that's only 268, 69 million. But the total fees of the $511 billion worth of PPP loans is, about $3.4 billion that the bar is trying to go after. So there's, as they say, there's some real money here, and unfortunately that just leads to these lawsuits. And I guess we all kind of probably saw it coming, but when you start looking at the numbers, you can sit back and say, well, yeah, that's unfortunately that's why.
One interesting thing too there, Mark, to point out is, what the plaintiffs are seeking in these cases has also been a demand to set aside this amount of money into a pool. So it's not just, to put aside the money for people who have actually made a claim for agent fees. Because in most cases, talking to banks across the nation, no one made claims for agent fees. Most banks had 1, 2, maybe 3. I'm sure, some of the largest banks had more than that. But this was not something that was common. Instead, what these plaintiffs are trying to do is have the bank set aside a pool of money so that anyone could later come back and supposedly come in and make a claim to these fees. It's not just the people who actually requested it, who had those pre-existing agreements in place. So there's potentially a ton of money at play here if you arguably go down the theory the plaintiffs are trying to advance.
Yeah, and I don't even know, Brad, maybe you've seen some figures on what type of fees have actually been paid at this point by SBA, but I'm guessing there's a lot held up in limbo, and I guess that would make it a little bit easier if somewhere someone said, hey, let's isolate this money. It's like anything, if it's still at the SBA, it's easier to do that. Hopefully that will not be the case. Let's go to the next slide and shift gears a little bit, because there's a second front of, I guess, challenges or potential landmines for banks out there, which is now we have the Department of Justice investigating various PPP loan programs. I guess starting back in April, one of the assistant AGs stated publicly that they have initiated a preliminary inquiry into possible fraud in the Paycheck Protection Program. And then I guess about a month later and earlier this month, it was revealed that a number of banks across the country had received civil investigative demands, or CIDs, related to banks' PPP loan programs, basically looking at the relationships between lender agents and borrower agents. And I guess we started seeing these was, a couple of the banks that got hit were public companies and disclosed that they were cooperating with the DOJ investigation, in an 8K filing, just to meet the disclosure requirements as a public company. And I'm not sure if it's a good or bad thing. Hopefully it'll show that there was no improper activity, certainly by the banks. But if you're a bank that gets hit with one of these, it's going to be a time suck and take resources and everything else. And it's just another problem that you're going to deal with for, like many other times, trying to do what was the right thing for your customers. And have third parties kind of intervening, causing this problem. But I think, sure, it started with the bigger banks that are being investigated, and as I indicated, a lot were public, but it's foreseeable it could filter down to smaller institutions as well.
And we are seeing a lot of that going down to smaller institutions, and it's still unclear where DOJ is going with these civil investigative demands. There's a number of theories circulating right now. One, obviously, is just given the nature of the CIDs that they're asking banks about their agent fee practices, is that the DOJ may be looking at banks who coordinated with lender service providers, meaning lender agents, and whether or not those lender agents had appropriate licensure, whether those lender agents were properly disclosed to the SBA under the 7A program. Because remember, a lender service provider, you don't necessarily get a Form 159 for, meaning it's not done as just a one-off form. Instead, you actually file a copy of that agreement with the SBA for your lender service providers, the copy of the compensation agreement. And then they're disclosed and can be tracked by the SBA, and then you as a bank can delegate certain obligations. If you were using a third party for underwriting, a third party for packaging and brokering these over to you, then you put that agreement on file with the SBA. They become a lender service provider, and you can then work with them and you pay them out of your fee. And so there's some question about whether or not there are certain examinations of those practices. There are also rumblings that the Department of Justice may be looking at certain unlicensed brokering activity or other activities that could rise to the level of needing a license, meaning someone fell within the definition of a broker in a state that requires commercial loan brokering licenses, and they might be looking at that, or potentially they're looking at the practices related to lender agents and borrower agents, and whether or not the lenders were appropriately diligencing them as set forth in the 7A program. It's still unclear because every state has a task force that's been established as part of the DOJ overall task force investigating CARES Act fraud. And so we're seeing a lot of this flowing down and the banks being pulled into it through these CIDs. And as Mark mentioned, not only is it a potential time suck, but also, anytime the DOJ is poking around, particularly in a program that was deployed this quickly with constantly changing guidance, there is the potential that, something untowards could have happened either intentionally or inadvertently inside of the program. So make sure you're really cognizant that right now, during this period of time, you're going back, making sure you're reviewing your policies and procedures. Make sure you're going back through all of those requirements associated with the PPP and then the underlying 7A program. And that could be everything from, looking at your BSA AML policies to make sure they're compliant with the revised guidance, to looking at how you were dealing with agents, to looking at how you diligenced customers. And we'll talk about some red flags that are coming up there for a lot. But, the reason why we think there might be some investigation, particularly related to the agents themselves, is we had an OIG report back in 2015, Office of the Inspector General for SBA, that had done a pretty in-depth analysis of fraud related to agents and the claiming of agent fees by these supposed agents. And, perhaps the most telling number is the rate of default increased 28% anytime a loan had a referral fee associated with it. And so in essence, they found these large agents were engaging in deceptive or fraudulent practices that ultimately were harming the U.S. Small Business Administration. And so just be prepared. You may get inquiries about that, and particularly if you're named in one of the agent fee lawsuits, DOJ may come behind that civil lawsuit and issue you a CID associated with it, particularly looking at your due diligence and oversight of third-party vendors and lender service providers. That's one of the requirements under the revised standard operating procedures that are cited there for your reference. A couple of procedural issues just that occur to me. All of these slides are available in the handouts and will be sent to you after the presentation today. Also, if you do have questions as we're going through, there is a question portal inside of the webinar software here. And if you do have questions that come up, feel free to ping us, and we'd be happy to try to address those as we're moving through, or there'll be a question period at the end.
I think also, Brad, let me just follow up on that. I think Colin's going to get this posted someplace on the TBA's website as well once we're done. So it'll be available in different ways.
The question is, where potentially could Department of Justice go from this? And this is just speculation, but if we look at what happened during the last recession relating to the FHA and certain loans that were made under FHA authority, the Department of Justice had set up a task force that used the False Claims Act, which is generally a criminal statute that prevents you from making false statements to the federal government under federal programs. And so when we look at what mortgage lenders were alleged to have done during the recession, what the Department of Justice was doing is using the False Claims Act to go back in and say certain lenders had made non-compliant loans. And so not only was that a violation of the FHA's administrative obligations, but the DOJ was pursuing investigations and criminal penalties against those lenders whenever the government had a loss and had to reimburse those defaulted loans. The big thing to remember here, and we'll talk about a little nuance that came out last night that's giving us a lot of heartburn in the industry. But remember, there were a series of certifications that every bank had to certify as they made their PPP loans. One is that they complied generally with the applicable lender obligations. And that's extremely broad because the CARES Act writes it extremely broad, but you have to comply with all lender obligations, and that you obtained and reviewed the required application information and documents for the applicant's loan file. Now, there's been a number of opportunities for the SBA to come in and say lenders are given immunity for what their borrowers submitted. SBA's never gone that far. Instead, the consistent message from SBA has been you're allowed to rely upon what the borrower submitted in terms of their documents, their data, their numbers. But it's up to you as the lender to check those calculations, determine the completeness, and really understand what it was the borrower submitted to determine if there are any facial problems. I was on another webinar this morning with a CEO roundtable of bankers. And for the individuals who have submitted forgiveness applications, by different counts, 70 to 80% have had errors in them, particularly for those who are just submitting the applications as opposed to using one of the application portals providing by some of the technology companies. And so, when you extrapolate that out, 70 to 80% of the applications they've received so far have some error in them. And part of that's due to the changing laws. Part of that is due to the complexity of the forgiveness application. But just understand, it's incumbent upon you as a banker to go back in and look at those calculations. You don't have to, go out and confirm that the payroll is what the payroll has been submitted, but it's your job to check and make sure the payroll is being properly calculated and that it's being carried forward into the various worksheets appropriately. So you do have some exposure there. And we'll talk about some more concerns that arose last night from some revised guidance got released about 10 p.m. last night.
Yeah, Brad, let me just jump in with 2 points on that. I mean, one, where it says that the lenders have to certify that they complied with all applicable lender obligations, as literally the rules were changing, evolving, whatever verb you want to use there, the SBA made it clear that, if you acted under the current rule at the time that loan application was accepted, you were held by that standard, not what came after. But I think the other part where they haven't given just the blanket immunity, in addition to sort of double checking the numbers, I at least my personal view is there's probably a unwritten, hey, the bank had to at least act in good faith here and not look at an application and know it was fraudulent and just kind of turn a blind eye or anything like that, which, again, would hopefully be a pretty limited case. But I think that's part of why they've left that open, that, if through an OIG or DOJ investigation see that a recipient of PPP funds really was ineligible and can figure out that the bank was complicit, I would assume they'll go after the bank as well.
Yeah, great point there, Mark.
I guess I'll take this one. So again, kind of now shifting to the third area of concern is fair lending concerns. And, again, I hearken back to, frankly, a conversation Colin and I had when this was all starting and, looking at the big picture. And I remember Colin said to me, yeah, somehow the banks are going to get screwed in this deal. I don't, he probably was more eloquent than that, but that was essentially his concern. And I hate to say it, and I hate to say it for the banks, not for Colin. He was right. And, so we've already seen where, the banks were supposed to be just as almost a conduit for this money. The agencies are coming out with fair lending commentary. So first we had the OCC, both back in April, OCC and CFPB, talking about tracking information, seeing how the application process was applied regarding, revenue and looking at the low to moderate income census tracts, distressed areas, underserved areas, and trying to encourage banks to funnel the loans to benefit the low to middle income individuals, families, and communities. Again, calling for, and is after the program's been in place for 24 days, it's more documentation of how the decisions were made, what business justification they had for, which applications they processed, which customers or new customers they turned away, et cetera. CFPB came out same day on its blog talking about, the anti-discrimination laws, equal credit, et cetera, protect business owners from, any type of discrimination, that small business owners who believe they're discriminated against could file a complaint online. So, again, you had banks, I think, very legitimately saying, hey, we want to help our customers. And I know a number of banks in this state, hopefully folks that are on this call, that the only reason they became a, PPP lender was to help their customers, to help their immediate community, and could be hit with a CFPB complaint that they turned away a non-customer solely because they were focused on their own customers, but, a claim of discrimination of some form or fashion. So, these, unfortunately, these concerns don't go away because, you have two issues in my mind of trouble. One, you have a flat out complaint from a customer or potential customer who didn't get a PPP loan that, will claim, hey, you should have given it to me instead of your existing customer, or you should have processed mine too. And then B, 8 months from now, 14 months from now, whenever your next exam is, depending on, frankly, I think the political climate at the time, you could have the examiners in there really scouring your records on, on these PPP loans that, at the time they were made were, theoretically just, a grant, being processed through the bank to your customers. So I think these are, concerns we need to be thinking about as we move forward.
Yeah, great point there, Mark. It's interesting. We gave an interview to American Banker a few weeks ago flagging this issue. And we think this potentially is one of the big fallouts from this, which is there's already lawsuits involving any sort of reordering the banks did in terms of the sequence in which they processed applications, any sort of criteria that were employed in determining who could or could not submit an application. And so just understand that to the extent that you didn't have formal documentation, formal policies and procedures, which candidly a lot of people didn't. I mean, you had a week or two to roll this program out live. Then you need to be spending that time now to go back and document how you thought through these issues. Because the last thing you want is for, as Mark mentioned, 8 months from now, an examiner comes in who, it's no longer the, thanks for getting in the trenches and fighting through COVID on behalf of the SBA. It's now your normal exam cycle. And they say, well, wait a minute, why did you deny this application or refuse to let these people apply? Similarly, there may be questions about how you notified customers of the PPP program. One of the things we saw with some extremely small banks is they simply left it up to the various lenders to reach out to their relationships. And so then you're going to get potential inquiries about how was it, broadcast? How did you notify folks? How do we know that Sue or Jim reached out to his or her clients in the same way and they didn't cherry pick people to get PPPs? Was there any issues with how you sequenced or ordered them, how you closed out incomplete applications? And then certainly either now or in the future, consistent with how you're handling your consumer or small business portfolio, may be a good time to do some preliminary disparate impact testing just to see if there may be an issue that develops down the road. Perhaps most importantly, we've been seeing some of our banks, while there's still some time left before June 30th, to really make a concerted effort to target PPP loans to LMI census tracts, low to moderate income census tracts, or to individuals in traditionally underserved groups, whether that's ethnic groups or racial groups, to make sure that everyone knows about PPP availability, and to the extent your bank is willing to lend to non-customers, that you're doing some outreach into those communities, because not only can it help in the event there's potential fair lending challenges to your bank, but also, candidly, this is part of the CRA commitment of the bank, and there's guidance, as Mark noted, from the OCC. They'll consider those types of outreach communities as part of your overall CRA rating. And so it does serve as a pretty interesting opportunity to reach out to some of those LMI census tracts, distressed areas, or traditionally underserved communities to really make this type of program available to them while there's still, until June 30th, a little bit of time left. And then consistent with that, we've already seen, if you've looked at the borrower application for forgiveness, that SBA is going to be collecting data very similarly to how data is collected for HMDA reporting purposes. So there will be a database created that includes information such as gender, race, ethnicity, and veteran status for the principals of a business. And so that data is going to be out there. Obviously, we have been monitoring some of the Senate hearings and the House hearings. That's been one of the topics of significant discussions as various senators and congressional representatives demanding that SBA and Treasury really look into lending practices of the banks and how they deployed those PPP funds. And just like in the HMDA data sets that we have for mortgages, there'll now be a data set generated specifically for PPP so that regulators will have that information to then use when they're examining your bank. There's still some questions to whether this will actually be published like HMDA data for each lender. We'll talk a little bit about some of the information last night about what's being published relating to the borrowers. And so given that this data is collected, it's potentially then going to be available where certainly your regulators and potentially the public may be made aware of your track record when it comes to lending to individuals in various veteran statuses, genders, race, or ethnicity. Other thoughts on that, Mark, before we switch?
Yeah, I was about to say, if the information's out there, I think, one, again, it will probably depend on how, just the climate is shifting almost by the day lately. But, if the information's gathered, I think there's a fair assumption it's going to be used by someone. If they decide to make it public, hopefully they'll at least do some sort of maybe a lender asset size, or if it's below, if a bank's small enough, it'll just be by, census tract or, just kind of broad demographic information, not anything too specific to the institution, but we'll have to see. And it's if they're gathering it, my sense is it will be used in some form or fashion.
Oh, great point.
So as we start talking about forgiveness, we all know that the application has already been changed with the passage of the Flexibility Act. And this slide, I won't go through each and every detail, but it basically looks at what the original program's requirements were in terms of the forgiveness period, the safe harbors, how much money had to be spent on payroll, et cetera, and I think certainly important, the maturity date on the note to what the Flexibility Act changed it to. So, for example, the forgiveness period originally was a very clear 8 weeks from disbursement, and then they shifted a little bit for paycheck cycle, but it was basically an 8-week period because in theory you were getting funding to replicate 8 weeks. So here was 8 weeks of time to use the funding. Now it's the earlier of 24 weeks from disbursement or 12/31. And the same thing with the safe harbor for replacing employees. That went, the June 30 was the cutoff date. Now it's 12/31, or the date of the forgiveness application. The safe harbor for replacing wages, same thing, hard date of June 30 to what's now a not so clear date of December 31. Unlike the deadline for replacing the head count that says or the date of forgiveness application, doesn't have that language in there. We talked about this yesterday. Brad and I both believe it was just a pure oversight, which I think so many of these things were because of how quickly it was rushed through Congress. But it's not clear at the time, or at the present time, I should say. And then the next big change was how much of the PPP loan a borrower had to spend on payroll, dropping from 75% to 60%. And you can over the other details on the page there, but I think that the bigger point is that things keep changing, and in terms of a bank's liability, I think you have to be very careful with how your officers are talking to the PPP borrowers, and everyone just needs to be unfortunately up on the most current information that's out there, the most current rule at the time, and that has to be communicated to the borrowers, to the extent possible and necessary. I think even update what you've told someone, say, hey, the rule was X on June 3rd, but now it's June 23rd, and the rule is Y, and like everything else, and I as best you can, I think that needs to be documented, because it's easy to envision a lawsuit down the road where some borrower doesn't get forgiveness and their claim is, hey, my bank didn't tell me the right information. Unfortunately, that's probably foreseeable given how the information has changed, but I think all you can do to protect yourself is to keep your folks as current as possible, so that when they're talking to your customers, they have the right information. If necessary, have them call people to update what they've told them because the rule has changed, and just document everything so you have a file that says, no, on June 3rd we told you X, on June 23rd we told you Y.
One interesting point to make there too, Mark, is obviously with the changes that came about last week, there's now the potential to, or at least all new loans made after June 5th will have a 5-year term not to exceed 10 years. There is the option for any bank to go back and extend their existing loans from 2 years to 5 years for those that pre-existing that had already been written. It's optional. There's no obligation. The bank will have to do it as a practical matter. If you're asking, so guys, how many folks are doing it? Most of our banks are working to try to extend those programs either through voluntary extensions by letting borrowers know that that's available, and then they're allowed to giving those borrowers the option to opt in. Or we have some banks who are actually going to go so far as to say, yes, we are going to allow that extension to occur. We're going to do it unilaterally, and the borrower is then given the option to either pay on a 5-year cycle, 5-year amortization, or on a 2-year amortization, depending on which option is available at that time. And the bank is just simply giving them the option of which one to pick. So, something to be thinking about right now as you consider your procedures associated with making those changes. One of the biggest things to remember there is, depending on what you do there, make sure you remember that fair lending also applies to modification and workout plans. So if you're just going to offer it to a few people, be very careful about who those few people are. Make sure you have documented policies and procedures for why you selected those individuals to offer the extension, and just be aware that any time you make that type of policy or procedure and it treats different borrowers differently, you potentially have some fair lending issues that'll come up and tag you there as well.
Yeah, that's the exact point I was about to make, Brad. If my suggestion would probably be, I think you need to make a sort of institution-wide. We're going to keep it at 2 years. We're going to move everyone to 5. We're going to give everyone the option. And if you do just cherry pick, I'd say you need to have a very, very good reason and have it very, very well documented.
Great point. And, one of the things we did want to flag for everybody, and this is playing into some of the press in the last few days, this was this morning in the Journal. Two things that are becoming top of mind. One, SBA has said that anyone making or obtaining more than $150,000 is now subject to disclosure, meaning they're going to release those borrowers' names, certain other information about the loan, and their paycheck amounts. So all of that's going to be public. So you've got some potential reputational issues that you need to be covering with your borrowers as that gets released. But also, if we're thinking about what that means globally, and if we're reading tea leaves here, there's continuing to be a push for an ultra-simplified forgiveness application at the $150,000 level. Interestingly, that is the level that the SBA has said they will release names. And so this may be telegraphing that SBA is thinking about this $150,000 or less PPP loan as somehow being different than those obtaining more than $150,000. So something to be just kind of keep in mind is there could be that cutover that the SBA is starting to look at. Obviously, there continue to be headlines. This was also from the Journal this morning that they're looking at TLSS, which was a delivery firm, saying, wait a minute, these people got less than $2 million, but they are, quote, defrauding the government because they didn't need the money. Why this is important is last night a series of guidance documents were issued, updates to interim final rules. And the SBA brought this language back. We all thought we had gotten past the necessity certification and they weren't going to look at necessity for loans less than $2 million. And then last night, the SBA snuck this back in on us, which is the SBA, in the course of its review, can examine the terms of the borrower's PPP loan application, such as whether the borrower lacked an adequate basis for the certifications that it made in its PPP loan application. If so, the loan will not be eligible for loan forgiveness. So this is not necessarily rewriting existing rules, but it's interesting in last night's guidance, SBA is continuing to say they're going to look at these applications and the certifications these borrowers were making. So some of these companies, like, I guess the one the Wall Street Journal was referencing, TLSS, allegedly, was involved in making certifications that weren't accurate because their business was actually going gangbusters as part of the COVID crisis. When we see this happening, SBA, once again, telegraphing they may come in, try to re-examine the borrower certifications and the certifications in the application.
Yeah, which I think is obviously very, very problematic. Is they sort of tackled this issue once, gave a safe harbor for folks to effectively turn the money back in, and we're well past that. And it's revisionist history is never very good. But you look at at the subject company here that's a delivery service. Well, sure, most of us that have been spent however much time working at home, at least in my neighborhood, all I saw out my window was delivery trucks all day long. So sure, you could see that they would be doing well, but I think the original SBA sort of language of, the necessity was, well, if you're a big public company, if you're, big sophisticated entity, you'll have funding elsewhere. You can go to the public market, you can go to your lender, and you'll be able to get funding. For this company, who really knows if that's true? It could be a small, I don't know much about the company, could be a small company, and as you're, at the time on the face of unknown, I think going after funding is probably fair for anybody, but in hindsight, they might get tagged on it. So I think it's extremely problematic, and I think again it goes back to what I said before. I think the borrower has great exposure, but with the lack of, quote, blanket immunity for the banks, if SBA determines that this TLSS delivery service in Florida defrauded them because, quote, their business was going gangbusters, they might look at the bank next. So I think, again, it's an unfortunate position I think the bank's going to be put in, and what you can do now I think is just best to, again, make sure your file was as complete as it could be, which I guess turns to our next slide here. So, again, topic of today is liability that folks are facing for being involved in the PPP program. And it's, another avenue of cases we think are going to come out is going to focus on, how did an individual bank develop the forgiveness process? What was their internal mechanism for helping borrowers get the loan, forgiven? As I said before, are they making the borrowers aware of everything and staying up to date on what's needed to apply for forgiveness, what the deadlines are, because those are changing? What's the bank's internal policies and procedures for recognizing a fair lending concern that would have happened in both the servicing aspect and especially the forgiveness aspect? I think the bank would have to have a set procedure for identifying the eligibility criteria for forgiveness and how they communicate that to the borrower. I think the banks and the employees, to protect themselves, should avoid consulting with the borrower on how the funds are being used or any any content of the borrower's application for forgiveness, outside of the specific language from the SBA's guidance. And I think the banks need to make a clear disclosure that, eligibility for forgiveness is the SBA's determination under the SBA's rules and regulations, and then the bank doesn't have any input on that criteria. Now, I'm not suggesting that's going to, save someone from suing you, but I think, you need to have that communication and have it documented that, the decision on whether that loan is forgiven is not the bank's, but the SBA's. And I think we can tie to the next slide here, Brad. And those of you who heard me speak before, probably some of this is going to sound familiar, but what's the best defense to a liability claim? It's the properly documented loan file. And the more you can document the discussions you had, now you have proof that you had the discussion. I've always talked about, in presentations about board meetings, if it's not in the minutes to the examiner, it didn't happen. Well, I think in these lender liability claims, if it's not documented in the loan file, a plaintiff's attorney can easily claim it didn't happen. So, I think communications with your customers need to be very clear, very, very objective, very unemotional, and all of those, very professional setting, but everything needs to be, done with the thought process. It could be an exhibit in court. So I think you need to document that what you've done properly, and be careful to do everything properly, because you want to have what's in writing as your defense, not as an exhibit used against you. And I think that the challenge there, right, is how to train, not the folks on the call here, but all the relationship managers that are the ones that are really dealing with the borrowers, many of which are probably their long-term customers, and you need to, just be very clear what that communication should be. Let's hop to the next slide, Brad. Yeah, we're starting to run short on time here.
So if we're talking about where we think things are going, and certainly feel free to start popping those questions in if you have them. We need to be cognizant of both regulatory and civil liability here. We've talked a fair amount today about fair lending and Reg B violations. Remember, that can be potentially in your application, your lending, or your forgiveness program. So make sure you're cognizant of that and thinking through any efforts you need to take right now to try to address those, or any remediations potentially you may want to do proactively. One big thing the regulators have focused upon is there were a series of changing guidances related to what your BSA AML obligations were relating to existing customers and new customers applying for PPP. Make sure you've got that documented, particularly to the extent it diverged from your existing BSA AML program or your existing enhanced due diligence program. And then, as we flagged already, make sure you're cognizant that DOJ is sniffing around False Claims Act violations when you submit your 2840H or your lender applications for forgiveness, or you're dealing with agent fees, that potentially there are pitfalls there. You need to be very deliberate in those submissions. Similarly, be aware there are potential lawsuits waiting in the wings. There's already the eligibility lawsuits, the loan prioritization lawsuits, and the agent fee lawsuits. We expect there to be a series of lender liability lawsuits, particularly if borrowers are not having their loans forgiven. They may try to point to different things your bank did that, quote, caused them not to have their loan forgiven. So be really careful there. Or perhaps even more, we've seen this occurring lately, is that potentially PPP loans may be triggering defaults under existing debt facilities. And there's some question about whether or not your bank is able to trigger another covenant in a different unrelated loan because that borrower obtained a PPP, because arguably that was them exercising a right to governmental benefits. And so if you have certain mechanisms that automatically default other loans, that could jump up and bite you. So really be careful about those potential covenant breaches if those covenants relate to the PPP program. And then I think we'll just cover together some of the things you can be doing now. If you take one slide away, it's this last one. Forgive us for hiding the lead on this a little bit. These are what you can be doing now proactively before your next exam, which is make sure you're documenting. all of this was run out in such a extremely fast fashion so that we could help people get the funds out to small and medium-sized businesses. That being said, as we're going back, we're working with a lot of our banks to go back and document their processes, their thinking, how they were working through these issues, and then particularly focus on this. Make sure you're not doing anything that would impact the SBA guarantee. Make sure you understand what the borrower has to certify, what your obligations are to check it. Make sure that those applications are complete. You may even consider using one of the technology vendors that's helping with forgiveness applications. The cost of that's dropped dramatically given some of the competition, to where it's below $80, some are below $40 per loan for forgiveness application processing. Just remember they might count as a lender service provider. Got to be careful there. And then really make sure you're treating this in the same way you would your standard commercial loan portfolio. Make sure you're running your standard checks. You're doing quality assurance. Yes, this is a governmental program. Yes, it's largely guaranteed, but don't get sloppy here simply because of the nature of how this was deployed. With that, Mark, other final thoughts?
Yeah, no, I think, again, this slide probably is the most important takeaway. And again, I want to just emphasize, even in the first two boxes there, because things were done so quickly, even though it's retroactively, I would suggest trying to get things down in a file that at least explained what you did at the time and why you did it, because I think when the examiners come in, that'll be helpful. I really do. And again, I think the last slide is just touch on that again. And just keep monitoring anything that's coming through on the PPP program, both any updates and any complaints that may be received, and again, keep a log of all communication with your customers. So with that, I will turn it over to questions, and if not, we will wish everyone a good day.
Yeah, and so should you have questions, feel free to send them in, but want to thank everybody for joining us today. We know how complex and that this program has been and how often the rules are changing. Just remember what you're doing is a huge benefit to small and medium-sized businesses in a particularly troubling time. And, really just work on, even if you didn't do it ahead of time, going back and documenting, monitoring these programs in such a way that they're defensible as we cycle forward to the next round of examinations and, unfortunately, some of these lawsuits they're attempting to capitalize on the program. All right, well, Mark, looks like all the questions got answered as we went through, so thanks everyone for joining us, and we hope you have a wonderful rest of the day.
All right, thanks everyone.